Hello ladies and gentlemen, welcome to today's webinar. It is Friday, last day of the week, and today we will talk about a revised system, combination of moving averages with an addition of a few other instruments. My name is Joseph Novichkov. I'm the Senior Trading Manager with GDM. The chart you see in front of you is the system we saw on Wednesday this week. Simply, I've left it so we can work over it for the reason that the system we're going to talk about today is also suitable to combine this system you see in front of you with the one that we're going to talk today. Before that, of course, let's have a look at what happened when we spoke about the system last time. We saw the pivot point, the confirmation above the pivot point. We saw the commodity channel index breaking above the 100 level, signaling us upside. Also, if we of course switch to the 15-minute chart, we can see here pretty much the same movement, breaking the pivot point, reaching the first target on the resistance level, reaching the second one, of course, as a usual consolidation before reaching the third one, and of course aiming for even higher. However, we didn't really set any other targets, but it was probably going to be this one here. In any case, here, ladies and gentlemen, the commodity channel index with its setup, we can see that on every push higher it comes down to the lowest level first before it actually did that. In any case, the system is performing pretty well in a real-time trading on 15 minutes, 30-minute chart time frames as well. Today's focus, however, will be mostly on the 30-minute chart. You can also switch down to 15 and 5 minutes as well because of the setup of today's system. Now, before losing you too much time, and of course I will try not to take too much time today, especially with the system because it's been revised. There is nothing new as in indicators, just their periods have been readjusted. We will see with an addition of one other technical indicator, and we actually removed the relative strength index we've been using the last time with the moving averages. Today, however, we'll be looking at 2 moving averages instead of 5, but we've added a slow and fast stochastic oscillator. How we actually have set this one up so it can work better into today's market, you will see in the following minutes. First of all, I wanted to start with saying that there is by far the most easiest to use strategy today, along with the combination of this one in front of you. Of course, they both can be used as separate systems. However, bear in mind, using it together, sometimes you are going to be stuck in the overconfirmation bias, as we've been discussing this into our psychological states. This is also something that can prevent you from entering good trades, so be mindful of this when combining with something else. Me personally, I would pretty much prefer to use both as different, as separate particular systems, because the simple the better, and the more how to say, the more accurate in most of cases it gets, especially when giving us an opportunity to trade more with more trades rather than sucking into confirmation bias and of course losing on the opportunity to take on good trades. Starting first, we will set only 2 moving averages, as I mentioned. Of course, they are again exponential moving averages. So let's get ahead and just place them in. The first moving average that we will use, we will take a period of 5 for moving average number 1. The style here, we're just going to choose something less. And this one will be exponential. Something that it's well seen. However, this one I don't particularly enjoy. Let's take on the yellow color. It's a little bit better. Maybe we can also adjust a little bit the pixels here. Let's take this, make it a little bit thicker so we can see it better. The second moving average today, we will take on period of 13. Also, we are going to choose something much more neutral due to the slower moving average. So let's take the green. I think it's resembles a little bit better, so we don't get confused with the candles behind. Of course, the appearance is up to you to choose what you want. Without losing too much time, there is a third condition that needs to be met on this system. We're going to take the stochastic oscillators and adjust the settings here. It's in stochastic. In oscillators, we're going to take 3 different periods. Now those which I've been added here as an oscillator on the stochastic, the slow and fast. The slower one is the red dotted. You can see it's slower than the blue, the light blue stochastic line, which is the faster, which is one of those that we need. However, today we're going to, you can use the settings as stochastic as 1433 as well. However, sometimes when you're moving up and down, you might need to get a few more signals, especially on smaller time frames if you're going to do it. So I'm going to take 8, 3 and 4. So we can filter a little bit out on the smaller time frames, and as you can see, it looks a little bit better as to crossovers, because those are the signals that we're going to get. Now we're looking present days at today's market on the euro-dollar chart. We can compare it as well as with the other strategy here and the timing. As we can see, this is when the particular commodity channel index shows us positive movement on the euro versus the dollar. A little bit of heads up we're getting because the stochastic is a little bit faster from the relative strength index. That's why we're choosing another one instead of it. Also is a little bit faster than the commodity channel index, so it's giving us an early signal for an upside movement. And yet again, what we're taking here as a consideration is the crossover of the moving averages. Now, as we can see, the crossover for an upside movement occurs right over here on these 2 bullish candlesticks. You can see the crossover comes right over here. Also, there is no more crossovers before the bullish move. We have a crossover of the stochastic. The slower is crossing the faster stochastic is crossing the slower stochastic to the upside, which is rule number 1. And we've got a rule number 2, crossovers of the moving average pretty much at the same amount of time. However, if the stochastic crosses first, that's why it's our first rule. Crossovers of the stochastic can occur afterwards, but is rule number 2, if crossover of the moving average occurs after the stochastic, is also a positive signal. However, if we have them vice versa, it could be a false signal. So if we see stochastics and moving averages crossing at the same timeline, it's a signal to buy. If we see the stochastic crossing first, the moving averages crossing second, it is also a bullish signal. But if we see the moving averages crossing first and the stochastic second, there is about 40 to 60% chance that this is a false signal. So taking on these rules are the most important so far. Let's speak a little bit about the time frames that we can use these, especially in terms of volatile markets. This is when our exception of the strategy comes. Volatile markets, especially during certain announcements like the one that we're going to have in about 1 hour and 20 minutes. That's the non-farm payrolls report from the United States. This is something that can invalidate any kind of strategy. So beware of this, and please be mindful that after certain high volatility announcements, usually the trend continues up to 4 hours. So during that time, from 0 to 4 hours after the announcement, there is a high percentage of chance that your strategy will be flawed. And of course, it is also better to wait until the event has been crunched down to pieces and of course digested by traders and investors, so the market can start picking up on direction, mostly by technical buying or technical selling. Excuse me. So we can see another crossover here of the moving averages. Another signal comes pretty much at the same time from the stochastic, and as you can see, when the market is seesawing or zigzagging or sideways movement, pretty much this can be taken as a neutral stance. Therefore, you don't really trade during these conditions. Also, a verification of this you can get from the volatility of the commodity channel index, especially when it hits higher levels and then it starts to slowing down. That's why I said these two strategies can be combined together, but some of the signals can be ignored. Like, for example, the crossover of the movement to the upside of the commodity channel index right here comes in line with the bullish movement of the market, and this brings about 200 pips of profit. However, another signal you're getting here, but this is only one case, ladies and gentlemen, so don't get me wrong by expecting that every time the market will give you one and the same market trading conditions. You can see the sideways direction of the market here. There are multiple crossings during that time. You can see how flat the commodity channel index is, meaning lower volatility. But once the market is trending, from here example, another one, you can see the crossing of the moving average, the commodity channel index is happening one at the same time. But the crossing of the stochastic, now here, ladies and gentlemen, we're ignoring the higher in the overbought and oversold conditions in these cases of the stochastic, because the strategy is demanding it. So the crossover happens over here, even long ago, before this particular trend has been over. Now, this is a condition I would take. This is rule number 1. Let me take the pen one more time. Over here we have rule number 1 is met. Rule number 2 is met way over here, and this is when we're actually entering. And an exceptional, if you want to add, is in rule number 3. I'm just going to label it with a star here, because it's an exceptional one. You don't really need to follow it, but you can guide it. You can use it as a guide on the volatility of the current market conditions. And as you can see, rule number 1 is met, rule number 2 is met, and the crossover of the commodity channel index is also pointing downside. And then our exit strategy comes next. Now let's talk a little bit about the exit strategies here. First of all, I'm going to talk about the combination of the two strategies. Now, as targets, you can still use your support and resistance levels regarding of the direction of the market. You can see 1, 2, 3, 4, 5, 6 profit potentials here. And even if we scroll back, we can see those levels are acting pretty well always when the market demands it. Even your first was hit over here, your second and your first over here, and the market repeats itself due time. Now, when the trend is developing itself and the market is moving down in this condition, multiple crossovers you are going to witness. However, you can use those targets, and every time you hit another target, you are moving your initial stop loss closer and closer. Now, that means if you have opened your trade over here, it is obvious that at the last swing high, it will be your stop loss. That means somewhere over here. This is your stop loss. When the market hits your first target, for example, after this crossover, when the market hits your first target, your stop loss should be set somewhere closer to your entry point or a few pips above the previous high. That means the previous strong bearish candlestick was this one, not this one. We're taking the one previous after the crossover, which means you're moving your stop loss here. In a volatile market, as I mentioned, when there are a lot of news, we can see stop losses hit sometimes. Not often, but in most cases, there is a possibility that this could occur. However, in this case, appropriately set 5 to 10 pips above this candlestick's extremum would be appropriate. And in that case, even the market is missing it out, giving us an opportunity to cash in on further profits. Therefore, when our second target is hit, we have the opportunity to move our stop loss somewhere above our other target. So, as I mentioned, depending on the volatility of the market, in most cases, you will cash in on the profits that eventually you will need to reopen further positions when your crossovers of the moving averages occur due trend development. There is also, of course, another way to take your profits and move your stop losses. This is the most conservative way. There is a riskier way where, of course, you're ignoring the commodity channel index and you're ignoring the total take profit setup of the stop losses, and you're leaving your initial stop loss on the 100% up here. This is the more aggressive way of taking up on the market. In this condition, of course, you are witnessing a very huge amount of profits. However, please remember that in other cases, when the market is much more volatile than this, because we're looking at a 30-minute chart time frame, imagine what happens if you're trading on a 15-minute chart time frame. Those retracements are possible to happen anytime. So, if you are a conservative trader, you have to exit all of your positions and reopen new positions when the market is making a new swing high to the next swing low, of course. If you're more aggressive, you should open your position and exhaust the whole trend by leaving your initial stop loss at the first appointed level. It cannot really get more easy than that. Now, there is something here that I need to remind you. You know, traders that are just coming on the market, they have the tendency to, to exhaust all resources they have from the MetaTrader 4. By saying that, I mean they're using every tool the market, or sorry, the program is giving them. Now, this can make a trader's chart so complicated, so filled with tools and oscillators and moving averages and trend lines and whatever has been given to you to make it so complex that in some case you will get so confused in what you've done that you will end up, instead of making money, losing money, because you're looking for the over conformational BS, and this is something that you don't need. So that said, an experienced trader thinks by a very simple way. The simple the system is, the simple and the more accurate the signals can become. So if you train yourself to think that way, your progress will get very, very fast forward. Your profits will not be far behind. As we mentioned, let's have a look at the setup one more time. We have a moving average, which is an exponential, one with a period of 5, another one with a period of 13. We have a stochastic oscillator with setup of 8, 3, 4, or you can use the 14, 3, 3. However, it really depends on the time frame. For 14, 3, 3, you can also use for larger time frames like H1 or H4. For smaller time frames, below 1 hour, you can use the 834. It's by far much more clean, with less false signals, and of course will give you frequent possibilities during the day. The way we see it, if you're trading on at least 2 to 3 major commodities or currencies, you will have the opportunity to open between 5 and 10 trades per day. 5 is pretty much the minimum because we're looking at a 30-minute chart through 5 and 15-minute charts. So with this system, I have rarely opened less than 5 trades because the opportunity that the market gives me with this system, I can get up to 10 trades, which means with the appropriate money management system and risk management system, you can get about 70 to 80% profits from these trades. So basically 7 accurate trades or profitable trades. And why I'm saying the appropriate money management, this would be according to your balance, the amount of risk that you're willing to take per trade, so on and so forth. Therefore, you need to carefully assess the trading plan, its rules of engagement, in order to implement these strategies in it. Now, if there is, of course, an opportunity that you don't want to miss, and the system is giving it to you, take it, do not hesitate. Another thing, please, one more time, be aware of the volatile announcements in the economic calendar. We've seen how people have been wiping their accounts because of this, so be careful, please. Use accordingly the strategy that I give you, and of course, if you have any questions, you're more than welcome to ask your questions by just going to our website, find our support department over there, forward the question if the guys are not being able to answer the questions that you're asking. you can always ask for an account manager or a senior a trading department manager like myself, so I can get into a one-on-one session and answer all of your questions. If you just came to the market, or you just came to the webinar and you have very little knowledge of what I just said, or you need to get reminded, please be advised that in a matter of days we will refine and we will master this particular webinar, and we will upload it into our YouTube channel so we can review it one more time, because of all of our webinars are recorded and you can review them anytime you like. However, there could be also something you don't understand, therefore don't hesitate. We have a hotline, you can call us anytime you like. That's all for today. Let me remind you, in about 65 minutes we will get the recent Nfp report, so you will have the chance to trade one more time with caution, of course. If you are a news trader, be careful, especially around Nfp reports. A lot of mistakes can be made. If there is anything that you're interested in, particularly on this report, to find out what is our particular point of view of today's report, you still have about 63 minutes before the news are out, so you can find that out. Come to our website, get in touch with us, and we will answer all of your questions. And now, I wish you successful trading. I'll see you next week until our next webinar, which we will talk about another swing trading system, but of course we will add a few other more complex technical indicators, which will take you further and further to mastering trading with GDMFX. Thank you for being here. See you next time. Bye-bye.